In this video, we are going to talk about stock market crash. So before starting this video, please like this video and subscribe to our channel for future updates. A stock market crash is a rapid and often unanticipated drop in stock prices. A stock market crash can be a side effect of a major catastrophic event, economic crisis, or the collapse of a long-term speculative bubble. Reactionary public panic about a stock market crash can also be a major contributor to it, inducing panic selling that depresses prices even further. Famous stock market crashes include those during the 1929 Great Depression, Black Monday of 1987, the 2001 dot-com bubble burst, the 2008 financial crisis, and during the 2020 COVID-19 pandemic. Although there is no specific threshold for stock market crashes, they are generally considered as abrupt double-digit percentage drop in a stock index over the course of a few days. Stock market crashes often make a significant impact on the economy. Selling shares after a sudden drop in prices and buying too many stocks on margin prior to one are two of the most common ways investors can to lose money when the market crashes. Well-known U.S. stock market crashes include the market crash of 1929, which resulted from economic decline and panic selling and sparked the Great Depression, and Black Monday, 1987, which was also largely caused by investor panic. Another major crash occurred in 2008 in the housing and real estate market and resulted in what we now refer to as the Great Recession. High-frequency trading was determined to be a cause of the flash crash that occurred in May 2010 and wiped off trillions of dollars from stock prices. In March 2020, stock markets around the world declined into bear market territory because of the emergence of a pandemic of the COVID-19 coronavirus. Causes of stock market crash. When it comes to the stock market, there are a lot of things that can cause a crash. While it may seem like the stock market is this big, scary, and unpredictable beast, there are actually a lot of things that can cause it to crash. Here are some of the most common causes of stock market crashes. 1. Economic downturn. One of the most common causes of stock market crashes is an economic downturn. When the economy is struggling, businesses are struggling, and people are losing their jobs, the stock market usually takes a hit. This is because people are less likely to invest in the stock market when the economy is struggling, and businesses are less likely to do well when people are spending less money. 2. Interest rate changes. Interest rate changes can also cause the stock market to crash. When interest rates go up, it usually means that the stock market will go down. This is because people are less likely to invest in the stock market when interest rates are high, and businesses are less likely to do well when people are spending less money. 3. Geopolitical uncertainty. Geopolitical uncertainty can also cause the stock market to crash. This is because when there is unrest in the world, or when there is a risk of war, people are less likely to invest in the stock market. Businesses are also less likely to do well when there is geopolitical uncertainty because people are spending less money. 4. Natural disasters. Natural disasters can also cause the stock market to crash. This is because when there is a natural disaster, businesses are often impacted negatively. People are also less likely to invest in the stock market when there is a natural disaster because they are worried about their money. 5. Terrorist attacks. Terrorist attacks can also cause the stock market to crash. This is because when there is a terrorist attack, people are less likely to invest in the stock market. Businesses are also less likely to do well when there is a terrorist attack because people are spending less money. What caused the most recent stock market crash? The most recent stock market crash was caused by a combination of factors. Firstly, there was a buildup of corporate debt and leverage, which made companies more vulnerable to shocks. Secondly, there was a sharp increase in the price of oil, which hit corporate profits and led to a wave of share sell-offs. Finally, there was a loss of confidence in the Chinese economy, which sparked a global sell-off in stocks. These factors all came together to create a perfect storm that caused the stock market to crash. However, it's worth noting that stock market crashes are often caused by a combination of factors, and it's often difficult to point to one single cause. The buildup of corporate debt and leverage was one of the main factors that led to the most recent stock market crash. Companies had been borrowing increasingly large sums of money in recent years, and this made them more vulnerable to shocks. When the price of oil started to rise sharply, it hit corporate profits and led to a wave of share sell-offs. This in turn led to a loss of confidence in the Chinese economy, which sparked a global sell-off in stocks. The combination of these factors created a perfect storm that caused the stock market to crash. However, it's worth noting that stock market crashes are often caused by a combination of factors, and it's often difficult to point to one single cause. So this is our today's video. If you like our video, don't forget to subscribe to my channel or hit the bell icon. We will meet again with another interesting topic. Till then, stay safe and stay happy.